well, it was great just 2 years ago.
What?
Guys, let me tell you what. Almost 2 years ago, I did a video called The Dark Side of YouTube Real Estate Investing. And, everyone called me a hater. This is almost 2 years ago. I uploaded this video August 24, 2021. That's almost 2 years ago. And everybody was like, oh, Orlando, you're a hater. And I was like, listen, the math ain't mathin'. Make it make sense to me. Well, what am I talking about? I'm talking about all of these real estate YouTube syndications going underwater, and it's the end, guys. And I'm trying to tell you 2 years ago that this was gonna happen, but we're gonna get into it, guys. My name is Orlando. Welcome to the channel. Make sure you hit the like and subscribe button. It really does help out the channel, but let's jump into this, guys. These are the things that you need to focus on, especially for you guys who are doing this real estate investing stuff. But this has to do with the housing too, because it's going to cause a chain effect. It says the housing bust comes for thousands of small-time investors. Now, what are we talking about? We're talking about guys like, Grant Cardone, and there's a bunch of these guys that are online doing real estate syndication. Now, what is real estate syndication for you guys who don't know what this is? Well, basically, real estate syndication, it allows you to get into these funds and you just provide the funds and you don't have to do any of the hard work to actually run the property. You just give your money and you own a portion of it and supposedly you just get a check.
That's a terrible idea.
That's how it works. Sounds easy, right? I always say this, guy, if it sounds too good to be true, it probably is. And a lot of these guys, I said 2 years ago, it doesn't make sense to do this. You would be better off owning the property yourself and owning a smaller portion of a property. You don't have to put $50,000 to own $1 million property. You would be better off putting that $50,000 into a property that you own at $200,000 to $300,000 and running it yourself. You have control over it and everything else. But no. Everybody wants clout. Everybody wants to own $1 million. Go figure. Let's jump into it. It says, a few investors wrote the pandemic era housing boom as high as J. Now, I'm going to mess up this guy's last name, so I'm just going to call him J. Last year, J's company owned more than $500 million worth of Sunbelt apartment buildings with more than 7,000 units and was one of Houston's biggest landlords. So he's one of Houston's biggest landlords. The question is how did he get there? How did he get so many units so fast? It says Jay built his real estate empire using funds from dozens of small investors who wanted a chance to earn a landlord riches without any work. Well, what could go wrong with that? Look, I know a lot of you guys are Orlando, you're trying to stop us from getting the bag. And I'm like, no, I'm trying to stop you from losing the bag. A lot of you guys would think to yourself, oh, I'm just going to make this easy money. Let me tell you what, anything that is easy, you will soon be parted with your money. If you think that you're going to invest in real estate and wipe your hands clean and not even do any work at all, you're just going to get a check. You're going to end up in this situation because here's the thing. Easy getting in is an easy way to lose your money also.
True that. True that.
He pitched double money your return. Double your money. Can do talks at investor conference and YouTube videos. He described buying buildings with plans to upgrade units, raise rents, and sell for a profit after as little as 3 years. Woo! It sounds enticing, doesn't it? It sounds too good to be true. This is what I was trying to say in my video. I know it's not as easy as 2 + 2 = 4, right? I understand that, especially if you've never done real estate. But here is the problem. These syndication deals, they are hard to understand. You're going to get this disclaimer or disclosure paperwork, and it's going to have all this jargon on there. And if you've never done real estate, you don't understand P&Ls and tax. If you don't understand all of that stuff, how easy will will you be fooled into believing that this guy or some guy is going to give you, double or triple your return in 3 years? How easy is that? All he has to say is a possibility of 300x returns. And you're going to be like, well, of course, I'm going to sign on the dotted line. That's too good to be true. And that's what I'm talking about. It's very hard to understand. Easy for me to understand because I've been in the industry for almost 20 years. So I can see it and be like, this is nuts. Who would ever sign on the dotted line for this?
It's trash.
This is the point I'm talking about. It's not as easy as these guys make it out to be. Anything that's worth anything is going to be tough. There's going to be a barrier of entry, guys. It's just as simple as that. There will be a barrier of entry for anything that's worthwhile. Anything that's easy probably has a low barrier of entry and everyone will fail, or most people will fail. Jay's investors were, in fact, highly vulnerable to interest rate increases over the past year that crushed the business model they and thousands of others in similar deals across the US had hoped would make them wealthy. Well, yes, this is my point, guys. Interest rates going up. A lot of these guys were doing these arms, floating rates, and all this other crazy stuff. And now that they're in this predicament where things go up and people are deciding to either go other places for rent, move in with their parents, do roommates, people are deciding to move in a different direction. And a lot of these guys would have no problem trying to sell you this mirage and tell you things are going to be great. Don't worry. The interest rates are going to be low forever. The interest rates are going to be 3-4% in the foreseeable future. Matter of fact, we'll be able to get out before interest rates rise. Well, what happened in this scenario? It says, in April, J Company lost more than 3,000 apartments at 4 rental complexes taken in foreclosure, one of the biggest commercial real estate blow-ups since the financial crisis. Investors lost millions. Now imagine if you would have invested in any of these real estate syndications. Imagine you thought that you were going to become wealthy because someone told you,
yes, you own part of a 3,000 apartment unit portfolio and you own 0.01% of it.
Now that sounds crazy when I put it that way, right? It sounds nuts that you would think that you had a chance at becoming wealthy. But a lot of these investors think just that. They think for them owning a portion of a 3,000 unit apartment complex portfolio that they're on the easy street to becoming wealthy, when actually they're on easy street to go on bankruptcy. Yeah. And then it says the company had taken out commercial real estate loans that carried floating interest rates and were adjusted each month. Ouch. Jay is one of thousands of real estate entrepreneurs in the US known as syndicators. Many have come under similar financial pressures and hold properties they can no longer afford. From 2020 to 2022, real estate syndicators reportedly raised at least $115 billion from investors, according to Wall Street Journal analysis of Securities and Exchange Commission filings. And when did I do my video? It seems, I can read the future. I mean, oh man, this is bad. But listen, guys, the reason why this is so important is because a lot of regular investors, people who know nothing about real estate investing, know nothing about syndication, know nothing about the lingo and terms and diving deep into this stuff, are now investing. And the reason why they're investing, or they're allowed to invest, is Congress in 2012 opened up the doors to syndicators with a law that made it easier to market real estate investments online. The law intended to open financial opportunities for lower income people, greatly expanding its reach and its audience for syndicator deals. Now, I get what Congress was trying to do, but the education gap is immense, guys. But if you take the word of the syndicator, what is the syndicator's motivation to really tell you the truth? Think about that. They are trying to make money through fees. They're trying to make money from getting the property. They're basically going to tell you whatever they need to tell you to get the deal done. And you have to remember, everything's in the guise of probably will make this amount in return. It's in quotation marks. Everything is, I might make it. The way my account is set up is That is the way that these disclosure sheets are set up. At the very bottom, it says, there's a possibility you can lose everything. Everything has a question mark on these documents. So it gives the syndicator an easy way to get out of the situation if things go south. And we're seeing they're going south.
It's funny because it's true.
And so a lot of this YouTube real estate investing is not looking good, guys. It's not. Now, how bad is it looking? Well, many syndicators are racing to either raise funds or sell properties before tipping into foreclosure. Most hold balloon payment loans that require repayment when they come due this year. Those syndicators face large payouts at a time when getting new or more affordable loans will be difficult. Why would it be difficult, guys? Well, interest rates at this moment for residential is at 8.1%. So what do you think it is for commercial? It's going to be 10%. Remember, guys, these guys were doing ARMs and floating rates at 3%. And now interest rates are at 10% for commercial. Can they afford that? And values of commercial real estate have went down. So now they're upside down. And now the cash flow doesn't even debt service. They can't even make the mortgage, guys. So what do they have to do? Sell at a loss.
Terrible.
Now, remember at the beginning of the video, I was telling you guys the math doesn't math, right? It doesn't make sense to do these syndications. Now, I'm not calling everyone who does syndication bad. I'm not trying to throw a blanket. I'm just saying that a lot of these syndications, it just doesn't make sense. And here's the reason why it doesn't make sense, guys. Syndicators generally invest little of their own money. They collect acquisition fees from investors that typically go from about 2% or as high as 5% on apartment building purchase price. They also take management fees of 2 to 3% from the building's gross income. Syndicators often profit even if the investment is a failure, which real estate analysts say encourage excess risk-taking at the expense of inexperienced investors. Now, let's just make this really simple. Really simple. If I'm a syndicator and I'm making almost 8% off of the top of doing a $1 million deal, I'm making $80,000 off the top. So if the deal goes south, I don't care. I've already made my money. I didn't invest anything to it. Tell me, guys, let's do the math. Let's do the math. If I invest nothing into buying a property, but I make $80,000 off of you, what is my rate of return on that? It's ridiculous. It is ridiculous. I made $80,000 in fees and didn't invest a dime. That's what syndication is. It puts individuals who've never invested in real estate in a predicament to where they're going to lose everything because they don't know this. They don't understand that a YouTube syndicator is going to pay $1 million over asking just to get a deal. You know why he can do that? Because it's not his money. It's your money.
Do you believe me yet?
He will make more money from that deal the higher the purchase price is. So not only can he get the deal because he's going to overpay for it, but he's also going to make money from the overpayment. How crazy is that? So where are all these guys learning the tricks of the trade from? Well, it says another gentleman that's in this article, his mentor is Grant Cardone, a former car salesman from Louisiana turned syndicator. I mean, do you see where the marketing is coming from? It says former car salesman from Louisiana. Listen. Let's figure out how this ended. So Jay, after all of his people lost money and his properties went into foreclosure, and Jay rode off into the sunset, and he's rich, and he did it legally because you signed an agreement that says you can lose everything.
What did he say?
Jay didn't care. And what did Jay say to all of his investors after he just pulled the rug from them and they lost all of their life savings from YouTube syndication? In early April, he sent his investors a letter telling them that the buildings had gone into foreclosure. Few things are more painful than having to notify investors of a failed business, he wrote in one letter. Jay offered a silver lining. Guys, I want you guys to, after you lose millions, after you lose thousands, after you lose your life savings, a syndication investor is going to tell you this. He's going to give you a silver lining that's going to make your heart glow. It's going to make you say, "Aw, I'm not mad at him anymore." We suggest you contact your tax advisor to discuss how your investment loss can be recognized on your tax filings. So he said, there's a benefit after this after all. You can write off your losses on your tax returns. Guys, listen, I know we make these videos fun. I know I try to make these entertaining and try to teach you a lesson at the end of the videos. That is the point of my videos. But listen, a lot of people lost money in this scenario, in these YouTube syndications, and it's going to continue to get worse. We're going to see in the next year and a half, 2 years, there's going to be a lot of fallout and people are going to lose tons and tons and tons of money. And I would never want people to get into these scenarios. I can't do anything about individuals that have already invested. But what I can do is ring the alarm bells and let individuals know that if the math doesn't make sense, if it's too good to be true, you should at least have caution. You should at least look deeper and deeper and deeper and deal with individuals that are experts in this. Go to attorneys, go to your accountant that can be punished if something goes wrong, goes awry with the investment. Don't think that you can just trust any and everybody, especially if they don't have experience in this. Experience wins, not influence. It's so important. But anyway, guys, this video has gone long enough. Hopefully you got the gist of the video. Hopefully you were entertained. Hopefully you got value out of it, but you won't get all of your information from this one video, guys. I need you to watch this video here. It will help you learn about the housing market, financial news, and get into your first rental property, guys. I promise you the information you will get from these videos, it will be gold. I will see you in the next one. Thanks.